Good evening, ladies and gentlemen. This is Cool to Say Trading Frank. It's approximately 8:42 p.m. on May 29th, 2018. This is a free market update webinar. Try to keep it short and straight to the point. Session will be recorded, uploaded to the YouTube channel, and available for anyone for free viewing. It's been a long day, and I had to run around a bit, so and looks like people have been busy this summer evening. Don't have much of an attendance, but that's okay. Everyone can listen to this once it's uploaded to the Clueless A Trading YouTube channel. Full disclosure, this is purely for financial education, not for any solicitation or advice. And let's get straight into the webinar. The Italy situation with the political stuff that's going on out there hit the market over the weekends. Over the weekend, Memorial Day weekend. On Sunday evening, futures were up roughly about 12 points. There was quite a bit of positive news developments from the U.S. side on North Korea, on China, and the willingness of both the United States and North Korea to meet for the summit on June 12th. So all that was fine and good. And then came the mini Black Swan event, which is not something new, but hit the markets, especially the global markets, and the European markets started selling off, hit the global markets, and of course we had a down day today. This was unexpected, and that's why we call it a mini Black Swan, which is an unquantifiable risk event. It is not the end of the world, but it certainly puts in a kink, a fly in the ointment with what's going on overall. This is a bit similar to what happened in Brexit, but to a much lesser fashion. And the resolution to this Italian crisis, political crisis, will be similar, in my opinion, to what happened after Brexit, which was quite a sharp reflex bounce. If you all remember, I believe it was in June of 2016. May, June of 2016. It's a bit similar to the Greek crisis that we went through back in 2015, if I remember correctly. And so the playbook is pretty much the same. But in the interim, we all have to be cautious. We have to trade according to the charts, and people who are tactical traders can benefit tremendously in these type of volatility. We did that. I showed quite a few terrific trades today, both on the SPX, the SPYs off the lows, as well as on individual selective stocks. And that's really what we have to go with now. We have to go with selective stocks, which are telling their own story, and the charts are showing similar patterns, and we have to go with tactical moves on the market on the SPX and the SPY. I also will be revisiting the RUT, the Russell 2000, and the IWM, which has shown incredible relative strength through this overall market volatility, as you all know, because that's U.S. centric and not as dependent and what should I say, not as affected by global trade and market events. Anyway, saying all that, the key is that this is a very technical market. I've been saying that for years, but more so now than ever, and we have to focus on that. So that's what we'll try to do here tonight. So saying all that, what we are playing here are markets that are trading within a certain range. There are certain patterns in place. What you're seeing behind you is the S&P 500. We'll be visiting each of those charts very quickly over the next 20 minutes, and hope you guys can understand what's going on. Let me just put a word of caution here. Okay, we're not going in a bear market. We're going through a minor corrective phase within a range, which I've been showing repeatedly, which was till today between 2,700 and 2,740. Today we fell back and ended the day at 2689. You can see that right here. So it might seem the world is ending, but we are basically down about 12 points from the overall range that we've been trading in, which is roughly 2,700 or 2695 if you want to be exact. Let's call it 2700, and the upper end of the range, which is around 2740, and mid range, which is around 2730. That's really what's going on. Now, the intraday volatility is extreme, no question about it. We're down to almost 500 points, I think below 500 points, and then we rush back and we end the day down 380, 390 points. At one point, we were down. During the day, the first part of the day, we were down only 145 points. Now, these fluctuations are structured volatility, institutional margin sellouts, all kinds of panic selling, which are triggered off by hedge funds. Hedge fund stops being triggered, all kinds of different technical reasons. We can sit here on one evening and discuss all of them, and it really doesn't serve any purpose. All you have to know on a broad basis that institutions and hedge funds primarily get hit when markets pull back so suddenly. They, especially European hedge funds, have Italian bonds in them, sovereign bonds in them, and other Euro sovereign bonds, or which simply means government bonds. And when those things are getting rocked, Italian yields climb very sharply. Then obviously their prices dropped in the Italian treasury bonds or government bonds, and the credit spread widened. In other words, risk widened, and you're gonna see them sell other stuff in their portfolios in order to come up with their margin calls. It's standard procedure. We've seen that happen in the U.S. markets. The same thing is happening here in the Italian markets, which is having a ripple effect across the global markets. So it's really that's what it really comes down to. Now, there's no way to contain volatility. There's no way that you can trade around it with absolute precision, but you can pick certain points, which I've shown very clearly here. As you can see here, these are the E-minis, which are roughly down about 4 points right now after hours. And you can see here what happened today. This was 9:45. This was 9:30 in the morning. 9:15, 9:30, the market started, and this is what happened today. So there are certain patterns that are being played out, and you can see here what happened over the weekend. This was the 25th when we closed the markets on Friday. If you want to see Friday's closing, that was here. That was here. Let me see here. 25th. There we go. This was Friday's closing. We were coming back nice. We gapped up on Sunday evening. Up to was the 2730 level. As I'd said, unfortunately, we couldn't trade. So we missed that part. And this is what happened over the weekend. Slid down. And then we had the U.S. markets open on the 29th, which is today. This was in the middle of the night. And this was where we opened today. So we're trying to move up. We played this very nicely on the calls for about 40% on the SPX calls, initial run. And then we had that. We had a sharp sell-off that ended approximately around 12 noon. You can see that right there. Very sharp move up. This is a falling wedge. I call it the Italian falling wedge, just to keep things in context, or what should I say, more relevant. That's why I call it the Italian falling wedge. And then we went up towards the upper end of the wedge at around 1 p.m. Pulled back, and right there at 3 p.m. we had a very sharp move, and the SPX calls, which were initially bought at around $6 to $6.50, which went up to about $8.50, $9, pulled back to about $5 or so, or a little lower than that, and they rushed up and ended the day at around $8.50. So active traders can actually trade these moves based on my charts. And based on what they, how much time they have in looking at active screens, and you can actually make a decent sum of money during the day. Another word of caution: you do not want to go in too heavy, even though this might be a powerful tradable bottom, which looks likely. We don't know. But I generally would not recommend and it's completely up to you to go out there and go crazy, saying, okay, this is definitively the bottom, the 2676 level, and you're going to put in a lot of money, and then it falls back again, and you do stupid things, you sell at the lows and lose money. So playing with a small to moderate amount can certainly pay the bills for the day. All right, so just keep it real simple. We have all kinds of traders. We have active traders who day trade. We have traders who swing trade for multiple days, and we have traders who mix in both styles. So it's all up to you. This is a 15-minute chart. You can see the resets back and forth. We got overbought right at the close. At around 4 o'clock right there, and we this minor move down, which is roughly down about 3.5 points now on the E-minis or the futures. You can see that the 15-minute is getting reset. Okay, so that's just the way it works. Now this is a bullish engulfing candle reversal. I called it stage 1. And this was the bullish engulfing. This could be called stage 2. And tomorrow, if we close, move down again, and let's say we are down tomorrow in the morning because of global market events and how those foreign markets react to what happened here in the U.S. today, all based on the Italian, political chaos going on there, then we might open back at 2676, which means that we will have futures opening down 14 points. That's just the nature of the beast. It's nothing I can do, nothing you can do. We just have to live with it. And as traders, we have to adapt to it. Now, that might create a triple bottom. I hope it does. If it does open there, and if it breaks there, then that's another story. We could easily drop down to 2650, which is about 16 points from where we are, where this today's lows were. And 16 points times 7, so you're talking about another 112 points on the Dow. You could have that very quickly right at the open on Wednesday, right? Tomorrow's Wednesday. So there you go. All right. So just giving all types of different scenarios. Now, if this plays out as which has had many times as a double bottom, inverse head and shoulder, then we are going to be opening up. Or not just opening up, maybe the first part of the day, we can get up to around 2706 or so, which was the breakdown level at around overnight, last night, or this morning at 10 o'clock when we moved up. Sorry, there we go, 2706. So it is very possible that we create that W bottom. That's an inverse head and shoulder. And we have major resistance here at the 2700 level. At that point, your calls will probably be up about 60 to 70%. That's a very decent number in these type of markets. And based on my charts, which are very, very clear, you want to take the profits. Re-enter as needed, or if you whatever you'd like to do. Bottom line is the charts are laid out very clear. If things really get if there is a powerful short squeeze, there is some sort of mild resolution between the chaos in Italy, some sort of positive catalyst news overnight or early in the morning from the U.S. side, then you should expect to see the markets, as you can clearly see here, trade up to 2716, which is a major downtrend line, or this was the uptrend line we were trading above, which is at 2724. Okay, that's quite a bit. If we, from here to from where we closed at 2688, if we go up to 2628, you're talking about 28 plus 12. You're talking about 40 points on the E-minis. You're talking about 280 points on the Dow, roughly, if we get up there. I'm not even pushing it that far. I'm simply saying that is a possible scenario. So that's it for this chart. Now, let's move on to the next one. The next one we are looking at is a chart that I constructed today. Very, very relevant to what is happening now. There is a large gap fill. We almost tested the gap fill. Good enough for a test. We had a sharp bullish engulfing candle. This is a 1-hour chart, so it's clearing out a lot of the noise of the 15-minute. People who are a little bit more calm and patient should be looking at the 1-hour chart to see the developments, and cuts out this type of heavy volatility that occurs on the 15-minute charts, right? So we all know that by now. As you zoom in more, you see more of the. It's like looking through a microscope, into a cell. And if you remember biology class, and you see a lot of things moving around if you're zooming in, but as you're zooming out, you start to see more of a structure. So we see more of a structure at this point. So if this gap is a tradable, what I call in these type of circumstances, I call it a tradable bounce. Volatility is traded through tradable bounces or tradable fall-offs, right? That's what we do. So here, if we look at a tradable bounce, there's quite a bit of symmetry here, and that symmetry again pushes up to about 27.43. In the meantime, it's never a straight line. We know that. So there's a gap fill here that's shaded in green, and that's between 27.08 to, and I put all this out on the Twitter feed, so feel free to look at all the numbers and stuff that I put out there with my comments. 27.08 to 27.15, which is the downtrend line from the 22nd, right there. See that? So very clear. So you could trade that too. If we make a sharp move, then we are going to hit a very powerful resistance level right at that downtrend line and the gap fill. We'll hit a resistance line right at the gap fill, lower gap fill at 27.08. These are good sums of money. And again, if you can scalp 40, 50, 60, 70% on a tactical basis during the day, I think that's pretty damn good. Very good in these type of markets. And I'm talking the SPX here and the SPYs. Okay, individual stocks delivered quite a bit today. Multiple names, as you know: Tesla, Micron, Nvidia, Chipotle, Align Technology, which is a powerful biotech swing trade winner, ALGN, all those were powerful winners. Amazon, you could have traded during the day, first part of the day, moved up very nicely, then pulled back. Netflix was up earlier on. So there was multiple trades which delivered very strong results during the day. With volatility, the chop around, the pullback, but the charts are there for you to navigate. So this is the structure we're looking at the 1 hour, and I've clearly explained what where we can go or not go. If we break out of the downtrend line, if there is a big push, then obviously this uptrend line is engaged at 27.34, and then of course the top around 27.43, which translates to about 27.48 on the S&P 500. On 1 hour, you can see here in the stows, the simple stows is overbought. There is a double bottom here. Generally, when we get this, oversold. So generally, when we get this oversold, we tend to have a reflex bounce. You can see that very clearly. This is a big one. Went up. This is a nice one. Here we are. This is how we ended the day. So if this gets overbought, then we should be testing the lower end of the gap. Next chart is the daily. So the daily is where the swing traders really focus on. The people who don't have time to watch during the day, they're looking at daily charts. What am I saying? They're looking at that, they're making their own judgment calls, own decisions. This is what it looks like right now. So here is 2018. We broke below the 2018 level at one point, but then we had a sharp, and I'm going to magnify this, zoom in. We had a sharp candle reversal once we kissed the 2018 level. On the futures, we actually kissed the 2018 break-even level. That's this pink line here, and you can see we immediately hit that. We had a hammer reversal right there. You can see that. This is all mechanical, all robotic. Respect it more. More you look at these charts, the more they talk to you, the better off you do. That's just the way it is. So right now, here is where we are after hours, and futures are down about 3 points, and this is where we are. Slight green doji. Not that it means anything at this point. Okay, very large sell-off. And this was the bulk of the sell-off during the day. I showed you what it looks like when it's broken down, right? On the 1 hour, I showed you what it looks like when it's broken down in smaller segments in the 15-minute. That's just the way it goes. So 15-minute, 1 hour, daily. So what's the key with the daily? This was the bull flag. This is what we're trading in, right? We did multiple trades successfully with these long tail reversals, and it was all fine and good. Now, here is the positive part. The full stochastics, look below here, is getting into that extreme oversold zone. Extreme oversold generally is below the 20 level, and we are not completely there yet. But remember that when we had these massive sell-offs, we didn't go that far below 20. We basically went to about 15. You can see that, and then we turn. So we shall see what happens here. We'll probably have it down open tomorrow, pushes this down into deep oversold, and if things play out the way these charts normally play out, we're going to have a reflex bounce. That means that this thing is going to basically go from here to there. By now, a lot of you, with my constant webinars, the advanced coaching sessions with some of you, know how these resets work, right? But generally, when we get into this oversold zone, we do have a sharp bounce, and you can clearly see that on repeated instances. And these are very large moves, right? 400-500 point moves, 600 point moves, and you can see that right there. So we're not there completely yet. So a down open tomorrow morning and a reversal would be a very positive thing. Now let's take a look at the bigger picture. What needs to happen? And I already put that down, so you already know the answer on the Twitter feed. What needs to happen for the bull flag consolidation triangle to remain intact? We have to basically go over the 2610. Let's just do this right. We need to go over, let's say, 2713 or so, and re-enter this level, in which case it's going to keep on doing this. That's going to resolve itself, in my opinion, up here towards what the original destination was, which was the big breakdown level around 2756, which equals 2760 on the S&P 500. These things matter directly to individual stocks, specifically banks, industrials, and those type of stocks, because those are the ones which are in the S&P SPX, S&P 500. You all know that by now, right? So banks got hit today hard, industrials got hit, and obviously that's what caused the market, the Dow Jones Industrial, to fall. Techs were actually doing pretty okay, and the Russell 2000 was doing fine under the circumstances, slightly down. So either that's going to happen, or it's going to come back and retest this level again. We don't know yet. This is an uptrend line. That uptrend line is still being held. That uptrend line breaks below 2666, and at that point, obviously, this zone comes into play. I'll certainly be alerting you guys, but remember one thing, and I do want to remind everyone. At certain times, given if I come in too late and the market's dropped too much, I'm not going to go out there and risk money into putting in a heavy short. If I feel that there is a chance to do it, I'll do it. I'm as robotic as possible, but doesn't mean I'm going to do every single trade that might be a winner. It's up to you. If you feel like shorting, you see this break, you're like, that's it, I'm going in, I'm buying the SPY puts, I'm buying the SPX put. Feel free to do so. Many of our traders do. You don't always have to rely on me, because I'm juggling other trades which are working out fine. As I mentioned, Micron, Nvidia, Tesla, which was a huge winner, and things like that. So I might not be willing to put in any type of substantial money. I might not be willing to put in little money to make little money, because it's not worth the risk for me or the time. So you feel free to go ahead and short based on these charts. That's what they are. They're tools, they're roadmaps, and you'd be very happy. Many of our traders do that, and that's fantastic. All right, because I provide the tools, and you decide what you need to do. In the meantime, I have my selective alerts that go out. On certain days, if it's too volatile, in my opinion, don't trade. Just sit back a bit, because really choppy days where there's no directional flow, even though it looks like, oh my God, the market's going down, but every time you're trying to short, you're losing money, you might just want to step back. Like they say, as professional traders, some days I trade light, some days I trade heavy. Just the way it is. So we need to basically go up over 2714 or so in order to recapture this bull flag triangle consolidation, and then we see what happens. All right. In the meantime, the good news is that we are getting deep oversold, so that shows a signs of capitulation. panic, certainly for sure. The TRIN level, which is the arms index, look it up on Investopedia, what the arms index is, which is also known as the TRIN, New York Stock Exchange TRIN, TRIN, was up to 2. That's a lot. That's a lot of panic in one go. All right. So generally, it creates a tradable bottom, and it reflects a sharp reflex bounce over 24 to 48 hours. That's just been the case. Many of you who have been with me for a long time know exactly what I'm talking about. All right. So let's move on. This is a weekly chart. So we are going from 15-minute, 1 hour, daily, and now weekly. So if you look at the weekly chart, the uptrend line is still intact. That was the little, on the stochastics. You can see that. That's why I drew this. You can see that. It's still generally on an uptrend. This is where we are right now. This is going back to 2016. You can see that right there. This is a weekly chart, longer term picture. And when you look at this, it's hard to determine whether or not, and certainly the possibility is there. So I'm going to show you both probabilities and scenarios. That this is going to break down, retest, and create a big double bottom, in which case we are going to come and retest 2600 or so. So you're talking about another, 5 to 600 points. And that's only if the weekly chart completely breaks down. Remember, the weekly chart is not showing you the noise on the 15-minute, 1 hour, even on the daily. This is giving you the bigger picture. So looking at that, technically this is what I observe, right or wrong. Number one, it's retested the downtrend line, which is generally standard procedure. You can see that. Each of these candles are weekly. Obviously, you know that it's weekly. So it's retested it here. Last time it did that was on the 14th. There was a doji indecision, which was looking good, which was looking more of a bull flag, right? This was looking more like a bull flag. This can be called a consolidation channel, but that was looking more like a bull flag, and then came the Italian blow up over the weekend. All right, so there you go. If the Italian thing didn't happen and all that stuff, and read up on that. I put the articles up there. I don't want to spend time explaining all the the shenanigans of Italian politics. They have had 65 changes in governments in God knows, since World War II. So, they're the masters of confusion. But it's a very developed, it's a powerful trading, developed economy, and it does have ramifications across global markets. It ain't Greece. I mean, Italy, France, Germany, France, Italy, Britain. These guys are the powerhouses in Europe. So at this point, technically speaking, it's retested the downtrend line again, and you can see that right there. And let's do this. As I'm doing this, just like to remind everyone, when you look at charts from a robotic standpoint, you start to see things which will help you in your trading than if you're just getting too emotional. We all get emotional. I didn't want to see the market like that today. Okay, but at the same time, I am as much of a robotic trader that I can, and I try to improve myself every single day, and I look at the markets in a very, very mathematical fashion. That's what I'm trying to help you guys with. So looking at this here, this level here is very critical, 2652. If we get down there and we break that, then we're going to break the downtrend line. I'm sorry, the uptrend line, this nice uptrend line in green, that's uptrend channel. And once you break that, then this comes into play. It's not going to be a straight line, that's for sure. There are times that I've come in late and tried to short and lost money, okay? And I'm sure it's happened to you guys a lot too. So whichever the case, this is your support line, which also coincides with a retest of this channel, lower, uptrend line. I'm sorry, this lower channel. This is your channel. This is your uptrend line. So is it possible that it does this, slips down a little bit, moves in, and then makes a sharp move higher? Absolutely. Don't forget, there are a lot of positives going on. President Trump is doing an amazing job with the North Korean situation. They're still talking to Chinese, getting things done. Lots of positive information on that coming out over the weekend. And we have a Federal Reserve, because of all this stuff, is now probably not going to be that keen to raise rates that furiously. 10-year government bond yields coming down. Stocks have sold off. That means they're getting cheaper from a valuation standpoint. Our companies are doing very well. Tonight, Salesforce.com came out, major tech company, up nicely. So things are good. Uh, Economically speaking, things are good. But So we tend to forget all that. The average retail emotional trader tends to forget about that because they're just focusing on the moment. And, we call it hyperbolic discounting, where you just focus on the moment and you lose sight of the bigger picture. Hyperbolic discounting, right? Just what's in front of you. The recent news events are what's going to dominate, what's going to happen in the future. No, it doesn't work like that. All right? It doesn't work like that. And you know that over and over again. It creates volatility, creates fear, creates panic. It has no correlation to what will happen 3 days from now or a week from now. So that's why we rely on technicals. I'd like to remind people over and over again. So that's it. If we break this conclusively, then obviously this part comes into play. But a retest of 2750, a sharp move down, scares the living daylights out of everyone, then the market starts to move up. That's also a possibility. And the move from 2700 to 2750, what's this level here? 2760, you're basically, we closed at 2689, right? So 30 points. This is 30 points. The move from here to here is 30 points. So 30 S&P points, or 30 handles on the 30 points on the S&P 500, you're looking at a sharp move down of 200 plus points on the Dow. So be ready for that. It can happen. All right, it can happen. 210 just to come down from here to here on the weekly. Now, if it happens very quickly, far better. Like I said today, the faster and uglier the panic capitulation sells are, the better off it sets off for the remainder of the week. It'd have been great if the market was positive, but then you know what they would have done? They would have sold the market first thing off tomorrow. I'd have taken my profits very nicely on my setups that I have, and I alerted if the market went positive today, that's for sure, and leave a little bit out there. But generally speaking, the market, the way it ended today, technically speaking, is actually pretty solid, pretty okay for me. Now, saying all that, this is where we are. Now, while we're sticking to that, I don't want to talk about the stocks here. I don't want to spend the next hour doing this stuff. I want to keep this within a 30-minute range. And also, I've already gone past the 30 minutes. All the stock charts and stuff are on the Twitter feed. Feel free to review them and act accordingly. So let's take a look at the same picture on a technical view on Thinkorswim, and you can see here there's your 2018 level. We went below that, and then we went sharply above that. Okay, we are now above the 200-day moving average. That's your white line here, or at least at the 200-day moving average. Now, this is not the daily. This is the 1 hour I'm showing you first. Then I'm going to show you the daily. We have all the lines are drawn here, and you can see here that on the 1 hour, on a short for active traders, you can see here we're oversold. We're starting to get a crossover. Slight move higher would create a bigger crossover. And if we open up, let's say up 5, 6, 7, 8 points on the S&P E-minis or the futures, then we are going to be overbought again. So you want to be a seller at that point. Looking at the McClellan during these quick, sharp mini black swan events is very important. And I did notice one thing right before I started this session, that we have a positive divergence. Why? Right here, sorry, let me change this. And you guys should be, many of you have been with me and have taken ACS classes, listened to my webinars, especially the ACS student should see this very clearly. At this point, look at this. We went down here. Look what the McClellan oscillator did. It created a positive divergence. It created a higher low on a lower print of prices. Lower, higher. That is a positive, just using shorthand, divergence, DIV. Does that mean anything? Yeah, it does. Positive divergence play out. I've shown it hundreds of times over the past couple of years. So this is on the 1 hour basis. There is no positive divergence. I mean, we'll see if there is on the daily. So on the 1 hour, there is a positive divergence. Here we were at around 2703. We went to 2676, and where's the pen? Okay, went to 2676, but we created a higher low on the McClellan oscillator. Something to note. As technicians, we'd like to see that. So it was a good thing that I noticed this. Let's move on. Let's look at the daily. So this is your 1 hour chart. You can see there's a gap fill here, exactly the levels that I just pointed out to you guys. The lower part of the gap fill is 2710. I would love 2710. That's a lot of money for us who bought at the bottom. All right. And I alerted. So, and if you get the upper gap fill, wow, that's fantastic. That's close to the downtrend line, and that would be 2721. That's a lot of money. I don't know what you guys think a lot of money is, but that's a lot of money. When you can make 60, 70, 80, 100, 120% on your trades, that's a lot of money. Okay? Just face facts. You can even make 40% on the day on a particular trade. You should thank God, because that's a lot of money in the middle of a extremely volatile market. Let's look at the 4 hour. We're going to go one step at a time. So here's your 4 hour chart. Here's your 2018, and this is what happened. The 4 hour is almost there, not quite there yet. And if it gets once the 4 hour starts turning, and this is the first cousin of the daily, then you can stick with your swings. But things move so fast, your swing could be a day, or it could be 7 hours. In the old days, it used to be a couple of days. So you can see here very sharp hammer reversals. I showed that very clearly on multiple charts today, so do focus on them. I wrote long tail hammer. So these are long tail hammers. What does that tell you? That shorts were covering. The big boys are the so-called smart money. Not all big boys are smart money, as we all know that. They were all dead wrong on an Apple, just to give you one glaring example. So, but it seems like the shorts who shorted here, whether they be US shorts or European hedge fund shorts, they covered here, and you can see these are very long tail reversals. It doesn't mean they're not going to do this, but it certainly has to be taken into account, as I showed repeatedly on my Twitter feed, that these long tail reversals in many cases are money makers. Okay, and so I showed you the stochastics. Let's look at the McClellan. The McClellan oscillator again is minus 120. That's quite a bit. Obviously, being minus 214 is a screaming buy. So we're not at screaming buy levels yet, but you can buy and then scream, maybe scream a little bit more, take your profits, and then scream if the market goes higher. Just kidding, you know. But generally speaking, any time it falls below the 100 level, minus 100 level, means that we are starting to create a tradable bottom. Is diving. So if it pushed down in the morning, we open down, let's say, and we open down, let's say minus 200. Boy, my opinion, like that old saying, you gotta buy with both hands down. But we don't know yet what's going to happen tomorrow morning. So looking at this chart here, we notice that these long tail reversals were all at the 50. Remember, it's a 4 hour chart, but the 50 simple moving average, the 150 moving average is still curling up right there. This magenta line, this pink line. And here's your 50 moving average still creeping up on the 4 hour. Remember, the 15 minute, the 1 hour, the 4 hour is the active traders tradable moving averages. All right. The 5 moving average took a nosedive, obviously, because of today, but the 34 moving average is still climbing higher. It's very, very clear that despite this technical move down, 1 day technical move down, none of these lines and their movement and their uptrending bias has been damaged yet. If you keep on pushing down, obviously they're going to turn around, in which case you're going to short harder. Anyway, there's your 5 moving average. So obviously we'd like to see the 5-day moving, the 5 SMA start to turn. Whichever the case, both of these found after massive tails. These are big tails, 100 to 200 points. They found a home at these moving averages. Very important from a technical analysis standpoint. All right, there's a gap here shown, all that good stuff. Spend some time, looking at the charts and understanding it. Here's your daily. So let's take a look at the daily and see what's going on. Just a reminder, I have some fantastic charts on the VIX and that big, fat reversal inverted hammer sell-off twice during the day. That has to be, you guys have to review that. It's right there on the Twitter feed, and I don't need to remind anyone. Okay, the VIX chart, which I even posted at the end of the day, the VIX second red inverted hammer detected is and one of my best charts, which is at the end of the day, says SPY/VIX. The two ultimate algo HFT tactical traders roadmaps are very, very clear. If this VIX continuation happens, that was a big sell at the end of the day, which correlated with this with those long tails on the 4-hour. It's all codes working. That's what the algos do. That's why they write algorithms. So let's look to see a close-up view of what's going on here. Then I'm going to wrap up. All these lines, the 50-day moving average is sliding down, and that's at 2672 at this point, right? The 150-day moving average, which is extremely important, is still trending higher. You can see that right there, this line, right? 34-day moving average is trending higher. This was actually quite bullish when the 34 crossed over the 50, because if it kept on moving, if it keeps on moving higher, eventually the 50-day moving average gets pulled higher, which means we're back on the upswing and looking to attack the gap at 2750, and pretty much that's what was looking like till the Italy thing happened, right? So nothing more to report here other than the fact that nowadays I've been showing these charts and exactly as I'm showing it to you now, zooming in. So take, look at it, look at the gaps, get used to, by now, many of you have been with me for a whole bunch of months, should know what to look for. And especially the ones who have taken the advanced coaching sessions, you know exactly what to look for. So there's your gap here, 2701, 2704. To me, this I just zone into it, and I'm trading off each of these levels as an active trader. If I'm swinging it, I'm also looking at those levels to exit. So this is where we are. The stows on the full stows are still heading down, so that's not a good sign. But as a trader who's looking to trade during the day, or maybe just keep it for a day or two max, we're not looking to marry these things. You're just dating them. You're renting it. You're not owning them. Okay, so when you're renting things, you can make a decent sum of money, and that's my suggestion during these times. When we don't have a clear directional bias on the daily, you want to rent things for a very short period of time. So this is where we are. This is still sliding down. Let's take a look at the weekly and see what's going on. Obviously, it gets a little noisy. So the weekly, if I'm just going to magnify it. So the weekly is looking like this. Okay, let's call this a large cup. It is still a handle. It is still a handle. And if you look at the weekly stochastics, there has been literally no damage, as I showed you on the weekly chart on investing.com just a few minutes ago. This is still a cup and handle. Yes, we can slide and slip. Things get completely off if we break below the 2650, in which case the 2600 level and the 50-week moving average, which happens to be this red line, comes into play. At that point, it's more of a confident. I can go in with the short with a large level of confidence on a swing short. But here, it's still a cup and handle. There's no, charts don't lie. Traders do. Charts do lie because of the volatility, so you have to know how to read them. But in general, charts don't lie. So look at this. Look at this cup and handle. This one is still a W pattern with the cup and handle built in there. So what does that tell you? That at least for now, it's not all hell break loose and everything's going to hell in the handbasket. All right, that's it. So guys, have a great evening. Thanks for attending. See you guys tomorrow. Stay vigilant. Individual stocks, we have a lot of winners. We have a lot of winners, guys. The ones where they are, you got to focus on them. Don't always be chasing the Netflix of the world and stuff. Netflix is very overbought in my opinion. It can still move higher because the hedge funds will all want to be in there. But the fact is, if you stick with the swing trades, going to show you a couple of quick examples. This is a fantastic chart, Chipotle. All right, that's a bull flag. Got to be patient. Buy the cheap lottos. You got to sit with it. Keep on rolling them out. June 15th. June 30th, July 15th, just keep on rolling because unless it breaks completely down into this channel and below this level here, the stock's going higher. This is a good looking chart. And I've been saying that since 280, all right, since it gapped open here. And we have traded a lot of these moves too. But this was the high confidence trade that I said, get into it, sit patiently, the stock's going to go to 400. And boy, it went past 400. And I'm telling you, based on the charts at least, that we could very well go over the gap fill. That's 468. We could go to 500. That's it. Take a look at Tesla. This is Tesla. It really blew just completely killed the shorts today. All right. This chart. There's nothing wrong with this. This is your gap level. This is this famous buffer. It doesn't need to break. It breaks this. You can short Tesla all the way down to 244, in my opinion. Or at least a gap, down here to 250. But in the meantime, you can trade this stock for 6, 7, 8 points. Buy a couple of calls. They're not super expensive. You buy them at $1.80. They're at 330, 360. That's 100% on your money. So this is not rocket science. You just got to look at this chart. All right. And I don't want to go into they're either Tesla haters or lovers. I'm neither. I'm a Tesla trader. Okay. And the Tesla haters, they keep on hearing the same old cockable story over and over again. They're running out of cash. They're going to go bankrupt, blah, 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 blah. Don't want to hear it anymore. I just trade stock. That's it. So next move is, next stock just wanted to quickly show is Google. It was starting to move higher. Then it fell back. It's still there. It's very deep oversold on the daily, and this baby's going to bounce just the way I said it was going to bounce from all these levels. It's going to bounce, and it's going to bounce most probably looking at it from about 1065. So the small amount that I did my first entry is still holding under the water, and I'm going to add to it if it holds to 1064 because the next move is right here, 1086 and then 1100 on a day that all these stocks move. That's the way it goes. Trade charts, guys. Trade charts. Okay. Apple. This is it. This is the trading version. The 15-minute version. The daily version of Apple is this one. Looks fine. They're lottos. They're 40, 50 cents. Look at the volume on Apple today. It looked like it was going to, all iPhones were. Today was the 29th, right? Wow. Look at that green candle. I didn't even notice it till now. Look at that. Beauty. And Apple broke out of its consolidation channel. Does that mean it's going to be up $2 tomorrow? I don't know. If it's up $2, I mean, the market's on fire. But this is a damn good chart. You could buy it all the way, like I said, buy it at 187. It was at 188. People who trade stocks, you can buy a couple of hundred shares and make yourself 2 points from the lows. For options traders, nice. So really not much to say. Align Technology, huge winner. Been telling you guys to buy it all the way from down here. The stock's now at 326. I told people to buy the stock. This, back on, actually well before that. I didn't Align. I started trading the stock, and I didn't hold it all the way straight up. But I've been trading overall on the upside, and I've been showing you guys all the way from 230. I gave you a stock here up 100 points. 100 points, ladies and gentlemen. Many of you don't bother to even look at it, let alone buy it. This is 100 points, and I have to highlight this because I've been talking about this stock, ALGN. Okay, 100 points in 1 month. This was April 25th. Today is what? May 25th? You could just trade one call and keep on rolling it up. It's not rocket science. No one's asking you to go out there. In fact, I ask you guys to do nothing. I ask you to make your own decisions, to put a big chunk of money in there. If you did, then you'd be just, you'd be going out there screaming and shouting and getting referrals and everything, because you'd be like, wow. In 1 month, 100 points. I won't even get to where the calls, even if you staggered it, which I do. I kept on telling people to buy the calls $5, $10 out, right? 1 month, 100 points from here to here. I rest my case. And on the calls, the average monthly calls generated 160 to 300% on each of the strikes that I mentioned. Average on each of the strikes or each of the trades. Nothing more to say. Have a great evening, guys. God bless you all.